Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before Dimitri comes on, please take a look at the disclaimer. Be aware, Market Chameleon, Dimitri, myself, none of us are registered investment advisors or broker dealers. If you have any questions relative to your portfolio, please reach out for professional help. This is for informational purposes only. Please take a look at the disclaimer again. With that, D, you ready to get started?
Yeah. So good morning, everyone. Let me share my screen. And while I'm doing that, if you're joining us for the first time, keep in mind, Will and I, well, we're not, and Market Chameleon, we're not a registered investment advisor, broker dealer, like Will said. So as a note, if, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into the live chat on YouTube, and Will's watching it. He'll read it back to me. And to give you guys a couple minutes to put in those questions, we'll start out looking at the pre-market report, and then we'll move on to the questions. Okay, so we'll see what kind of insights we could get from the pre-market report. Now, up top here, we see a calendar view with summary statistics on what happened in the pre-market on a particular date. So this way, if you want to go back in time to a historical date and see what happened in pre-market hours, you can do that. Up top, you can you can click on this, it'll show you a calendar to go back. We show 1 week's worth of data from a high level in case you could spot something unusual or trend. Today, we're on February 29th over here. And as you could see, so far we have 707 stocks trading higher in the pre-market, 304 stocks trading lower. As far as the volume goes, we have 167 million shares trading on up volume for 65 million on down volume. And if we convert that volume to dollar value, we have $5.3 billion worth of stock trading higher, $1.2 billion worth of stock trading lower. So from this perspective, looks like the trading in a pre-market hours so far has a bullish lean, or traders are trading with bullish sentiment. Let's look at it from a couple more perspectives before we move on to the questions. So I'm going to come down here, and now we see a list of stocks that are trading in the pre-market hours with prices, price changes, the volume in the pre-market hours, different alerts. We have a most active list, our biggest percentage gainers in the pre-market hours and biggest percentage decliners. I see 171 stocks made our percentage gainers list, 62 on our percentage decliners list. So from this perspective, it also points to a more bullish bias in the pre-market hours. Now, to make this list, we do set thresholds for liquidity, volume, price changes, because things in the pre-market hours are less liquid, traded with less volume. So if a stock is listed on a major U.S. exchange, if it's trading at pre-market hours and meets those thresholds, it could make it onto this list. And that includes stocks that are low cap stocks. You can see here market cap. We have low cap stocks on this list. Could be an ETF. It could be even a leverage or an inverse ETF. It could be preferred stock. So to narrow down this list to a small group of stocks, we could use the filters above this list. If you created a watch list and you want to track the stocks in your watch list, what's happening in the pre-market hours. You could use this filter, and it will show you your saved watch lists if you're logged in, and you could select that group, and this will get filtered by that group. We're going to use this filter in our example in ETF. I'm going to drop down, click on it. You get a drop down menu. So similar, if you create a watch list, you'd have names of your watch list, and then we're going to pick SPY. That's S&P 500 ETF. And we'll click on that. The list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we have 25 stocks that made our percentage gainers list, 4 on our decliners list. So from this perspective, it also points to a more bullish bias in the pre-market hours. And we looked at it from 3 different angles. They all indicate, similar pre-market sentiment. And we gave it a couple minutes, Will. So if you have some questions, I'll take them now.
Yeah, we had a new Chameleon ask a question about the order flow sentiment. He asks, how can we use the order flow sentiment to determine what stock options to, I guess, participate in or look at? So how do you take the option order flow sentiment and start researching trade ideas, I guess, is the question.
Yeah. So
and then while you're on the option order flow sentiment, he also does ask question 2, what does it mean bullish by deltas?
Okay, so I'll just go to SPY as our default. And under options, we have this order sentiment report. So the order sentiment report doesn't look at any one particular option. It's an aggregated report. It's cumulative of incoming trades of all the single leg options that are trading, in addition to, I think, the vertical spreads. And then it aggregates the report and creates summary statistics. Okay. Now, when we look at SPY, keep in mind an SPY is not a single security, single stock security. This is an ETF, S&P 500 ETF. It's most traded, and people are doing many different strategies in there, including hedging positions, rotating positions, and so there's lots of stuff going on in there that are offsetting other positions. Most of the time, it's probably what's happening. So what is, I guess the question is, what is the delta and what is it trying to measure? So whenever somebody does an options trade, right, whether it's a call or a put, you send that order into the market, right? It's an order that goes into the market, and that option has a delta. So at that moment, unless you stipulate stop contingent, it has a delta. The delta is it's directional risk, right? So if you have a deep in the money call with the 1 delta, it's the same thing as buying and selling stop. Some options have very low deltas, and it has very little impact on the stock. And the delta is the amount of stock you would need to hedge, right, at that moment to protect yourself from a directional risk for a $1 move. Okay, so it's a $1 move in the stock, and if you trade options delta neutral, if you're offsetting and mitigating your directional risk, you're going to re-hedge your deltas along the way. Okay, so let's just look at what an option, because I think it's important to understand what an option delta is to understand this report. So let's talk about that, right? Because I think that was the second part of the question, right? What is the option, like the delta mean? So I'm going to come down here. I'm just going to pick an option just to talk about here. You see these deltas here? These deltas on the left-hand side and on the right-hand side. So the left-hand side are the deltas for the calls, the right-hand side, deltas for the puts. And you could see they're different. Some are higher, 77, some are lower, 3, right? Now, what this means is if we take the options pricing model, Black-Scholes, means the following, that this option right now, right, based on an option pricing model, if this one for $6.29, $6.39 has a 77 delta, meaning that if the stock moves $1 up or down, right, if it's expected to change by 77 cents, this option. If implied volatility, days to expiration, no time decay, nothing else changes except for the price of the stock. That's the only thing that changes is the price of the stock. The sensitivity of this option is 77 cents. That's the immediate directional risk at this moment. Well, it's positive, meaning that if the stock goes up $1, this option is expected to gain 77 cents. If it goes down $1, this option is expected to lose 77 cents. And then you would recalculate everything at that point. Have a different delta or whatever, maybe a different implied volatility, but that's what the immediate directional risk is of this option. Okay. So how do you hedge it? How would you hedge it? Because if all you wanted to do was isolate your risk to the implied volatility, if you thought this implied volatility is low and the premium of the option, just the premium of the option is low, okay, and you wanted to isolate it to that by reducing your directional risk. So you don't have an opinion if the stock is going to go up or down. You have no idea, and you don't even care. You don't care if the stock goes up or down. You just think the relative premium is cheap. Okay. Well, if you want to isolate your exposure to the implied volatility, that means you have to mitigate your directional risk. You have to take it off. That's what a professional, whatever dealer would do if that's what their aim was, to mitigate their risk to the implied volatility. Well, how do you do that? Well, if you bought, let's say you bought 10 options, right? Well, 10 options would mean that if the stock goes up, it would increase, this position would gain $770. If the stock goes down, this position would lose $770 for a dollar move, right? Well, if you wanted to hedge that off, you'd have to sell short 770 shares, right? So if your options gain $770 on a price move, right, and you sold 770 shares, right, then a dollar move you would lose $770 on the stock. So whatever you gain on the option, you would lose on the stock for directional risk, right? Because you're hoping that the implied volatility goes up and those options would gain more than 770. But for the directional risk, if everything else stayed the same, you hedged it off. In reverse, well, if you bought the options, 10 of them, and the stock went down, you lost $770 on the option, and you sold 770 shares, and the stock came down $1, you would make that $770 back in the stock. Okay? So that's what the delta, that's what the Black-Scholes option pricing model tells us how to trade options to isolate them to and mitigate your risk, right? That's the sensitivity of the option to price changes, and that's how you're using these metrics to offset risk. Now, keep in mind, these are all approximations and things don't exactly work that way, but the idea is you're mitigating, you're close to mitigating your risk, right? And then obviously if implied vols change and time decay and interest, whatever else, those things are dynamic, it changes. But this is keeping everything constant so you could get close to mitigating your risk. Okay. This way you're not going to go out there if you think it's 770 shares, you're not going to go out there and sell 10,000, and you're not, and if you sell 100, it's not enough. You're trying to get close to where you're hedging off that risk. So given that, right, since the delta of the options are the directional exposure, what we want to, for this order sentiment, is we're trying to figure out, well, how much of the deltas, when option orders are coming in, how much of that is creating negative delta pressures, and how much is positive? Because if for example, all the order flow, was just buying calls, right? Like just continuously buy, that was it. Buying, right? Well, that's creating positive delta pressures, right? If it was buying this one, buying this one, buying this one, buying this one, it's creating positive delta pressures, right? And if it was all selling calls, it would create constant negative delta pressures, right? Because somebody on the other side, the dealers would be buying them, creating risk, those types of risk exposures. But it depends on the options too, because you could see here that, look at these penny options, right? These have small deltas. So even though people could be buying this out of the money call for 2 cents, it's not expected to really move, even if the dollar moves, even if the stock moves $1. At this point, it's too far away. It's 4% away, with 4 trading days. It's too far away to create a lot of directional risk of the stock move. It's more of a gap, right? This is more of like if the stock really, moves really quickly overnight, or that it's more of a gap risk at this point, because it's a wing. But if the stock moves $1, it's probably not going to change that much. It might not change at all. All right. So it's not creating that much delta pressure, not that much yet risk exposure. The stock has to get closer to that strike. All right. So those are the differences, right? Those are the differences in the delta pressures. Some options are creating more, some are not contributing a lot to the delta pressure. So the report here tries to interpret the way the order flow is moving, and if there is delta pressures happening, an overwhelming amount one way or the other. So that's the aim of it. It's on an aggregated basis. And when we look at it, right, we're just trying to see like if there's a trend. So you could see here trend, the trend's going lower, a lot of negative delta pressures. And on balance here, if we took the positives, so here's all the positives that we found, 92 million, and all the negatives, 97 million. So you could see it's really two-way trade. It's not overwhelmingly one way. Here's the pie chart, right? 51.5% towards negative 48.5% positive. So that's what it's telling us, that it's right now there's an imbalance towards the negative side, but it's not overwhelmingly, it's not like 100%. It's just there's more negative than positive, right? So I would say it's two-way trading, and maybe this imbalance isn't even that significant, all right, from day to day. Probably not, if you look at it from day to day. And keep in mind that SPY, it's a special situation. People could be hedging positive positions against their portfolios. And here we see that on average, the positive deltas on a weighted average, where were they established? At 505.96, the stock. The negative were at 505.95. So because these two are close, right? Because these two are close, what it's saying is that there's probably rehedging both ways going on as the stock is moving, because those averages are too. If we saw them wide apart, maybe that would indicate more like there's, something happened where the price was, $1 lower, and then it stopped, and something happened when the stock was like $1. But this is kind of telling us that on balance, there's, deltas coming in both ways, as the stock is moving, because these averages are very close together, right? So then we could go and say, okay, how, but we know that even the deltas, people could be selling calls, that creates a negative delta. People could be buying puts, that creates a negative delta. So what is happening and where is it coming from? So that's what we're going to go over here. So you can see here, there's more call selling than put selling, so these are where all the deltas, and then there's put buying, more put buying than call buying. So overwhelmingly, the top bar shows that a lot of call sellers, right? It's coming. So that does that mean they're getting super bearish? Not really, because why do people sell calls? People could sell calls because they might own the calls and they're just getting out of them. They might be buy writing their positions. That's a common strategy when people are long, and then they'll just sell calls because they want to collect time premium, and earn yield that way. People, could be doing, for many different reasons. The implied volatility, they may think it's high. So it's not necessarily because you think the stock's going to crash or anything, but you could be doing it for different reasons. But that's still creating, that those transactions still create negative delta, right? The act of somebody coming in, selling a call at that immediate, it's creating negative delta. So let's just take a look at it. So here, there's some positive deltas coming from the February 28th, 506 put. So this is the put that expired yesterday. And there's some positive deltas coming from there. So what does that mean? There's probably more selling of puts, right? The more selling of puts, selling the premium, right around that, the money. It's a strategy. It's a zero DTE options. It's probably a common strategy. From day to day, you'll probably see this because the at the monies on zero DTEs are very active, right? So you could see here, positive 6.4 million deltas just came from on balance from that option. Then we got some calls now coming up. 507 call, almost 6 million. 506 call, almost 5.6 million. So here's the 506, right? So basically what this is saying is that there's a lot of deltas coming in, it looks like, from zero DTE options. Just looking at these top three, right? Feb 28th, top four. Even here, Feb 28th. Here's one, Feb 29th. So even the top five were all zero DTE options, and they're kind of right around the at the monies. So I think that what this is telling us is that trading activity yesterday, centered around the at the money options. It looks like a lot of it, like looking at those deltas, were because we have positive deltas in the puts, right? How do you get positive deltas in the puts? You're selling. Negative deltas on balance in the calls. How do you get negative deltas in the calls? Selling. That there is quite a bit of, on balance selling in general, more selling of premiums around the at the money strikes. And, that's like where a lot of those deltas were coming from. And it wasn't a very strong, because directional bearish. It's more, to me, it looks like once we start looking at the details, is yes, there's an imbalance, but a lot of it's just coming from premium strategy selling around the zero DTs. Okay, so that's what this option order flow sentiment, as we go in deeper and deeper into the analytics, that's what it's shown up. Okay. Hopefully, that was helpful.
Awesome job, Dima. We had some nice comments from the chameleons about the quality of the product that's been created. Great job today, as always. You have a good weekend, my friend.
All right, thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Actually, not tomorrow. Tomorrow's Saturday, unless you want to do a show tomorrow.
Oh,
actually, no. Today is Thursday. You're right. Tomorrow's Friday.
Thursday. Yeah, that's what.
Shame on me. I did put the link to the next webinar with IBKR. It's going to be how to use the option profit calculator. Something we do show a lot on this show, so that should be a real good webinar. Again, we'll see everyone tomorrow. Thanks, D.
All right, thanks everyone. Stay safe out there. Again, hope to see you guys tomorrow. Have a great trading day.